Marcus was 28, had just landed a solid engineering job, and did what everyone told him to do. He opened a brokerage account and started investing. For 8 months, things looked great. Then the market dropped 22% in a matter of weeks. Panicking, Marcus sold everything. He locked in his losses and watched from the sidelines as the market recovered. Without him, that one decision cost him over $11,000 in missed gains. Today, Marcus has a six-figure portfolio, and he credits one thing: finally understanding the difference between a bull market and a bear market. That's exactly what we're breaking down today. Let's start with the basics. A bull market is when stock prices rise at least 20% from their most recent low, and that upward trend is sustained over time. Think of a bull charging forward, horns up. That's the energy. Bull markets are fueled by strong corporate earnings, low unemployment, consumer confidence, and economic expansion. Here's something most people don't realize. Bull markets, historically, last much longer than bear markets. According to data going back to 1928, the average bull market has lasted roughly 5.5 years. That's a long runway for patient investors to build real wealth, exactly what Marcus eventually learned to take advantage of. Now flip it around. A bear market is when stock prices fall 20% or more from their recent highs, and the decline is broad, not just one sector. Picture a bear swiping its paw downward. That's the visual. Bear markets are usually triggered by recessions, rising unemployment, inflation spikes, financial crises, or major global shocks. They feel terrible to live through. Here's the crucial part, though, and this is what Marcus missed the first time. The average bear market historically lasts only about 9 to 10 months. They are painful, yes, but they are temporary. Every single bear market in U.S. history has eventually been followed by a new bull market. Every single one. This chart is the one that changed everything for Marcus. Look at the S&P 500's long-term history. Yes, you can see those sharp drops. 2000, 2008, 2020, 2022. Those are the bear markets. They look scary when you're in them. But zoom out. What do you actually see? A long, sustained march upward over decades. The bear markets look like brief dips on a long green highway. This is the data Marcus needed to see before he panic sold. Had he just stayed invested through that 22% decline, he would have recovered, and then some, within 18 months. The math doesn't lie. Time in the market, historically, beats timing the market. Here's the number that stopped Marcus cold when his coworker showed it to him. The average bull market has historically produced gains of over 114%. That's more than doubling your money. Compare that to the average bear market loss of around 36%. The math is asymmetric in your favor if you stay invested. A 36% loss feels catastrophic, and it is in the short term. But a 114% gain on the recovery more than makes up for it, provided you don't sell at the bottom. This is exactly what Marcus did wrong. He absorbed the loss and missed the gain. Staying the course for long-term investors has historically been the more rewarding strategy. So how should you actually behave during a bull market? Marcus made a classic mistake many new investors make. He got overconfident during the good times and poured money into high-risk individual stocks. When the bull market ended, those positions got hit hardest. Smart investors use bull markets to build diversified positions across broad index funds, rebalance regularly so no single asset gets too heavy, and avoid the trap of thinking the good times will last forever. The goal isn't to squeeze every last percent out of a rally. The goal is to build a portfolio strong enough to survive what comes next and still be growing when the next bull market begins. Now the harder question: what do you do when a bear market hits? This is where Marcus learned his most expensive lesson. The worst thing most investors do is exactly what he did. Sell at the bottom and lock in permanent losses. Instead, consider these strategies. First, make sure your emergency fund is solid, 3 to 6 months of expenses in cash, so you're not forced to sell investments at a bad time. Second, keep investing through the dip using dollar cost averaging. That means buying consistently regardless of price, which means you automatically buy more shares when prices are lower. Bear markets, as painful as they feel, are historically when the seeds of the next bull market are planted. Let's look at the actual data behind major U.S. bear markets. This chart shows the worst downturn since 1950, how deep they fell, and how long they lasted. The 2008 financial crisis was the worst in modern history, a drop of about 57%. But even that recovered fully within 4 years. The 2020 COVID crash was brutal in speed, nearly 34% in just 33 days, but it bounced back faster than almost anyone expected. Notice something. Most bear markets last under 2 years. That context matters enormously. If you have a long investment horizon, 10, 20, 30 years, the data suggests that staying invested through a bear market has historically been more effective than trying to time your exit and re-entry. Here's something Marcus learned after his mistake. You don't need to perfectly predict bull and bear markets to be a successful investor. But understanding a few signals helps you stay rational when emotions run high. The official threshold is simple. 20% up from lows is a bull market. 20% down from highs is a bear market. Investors also watch the VIX, the CBOE Volatility Index, often called the Fear Index, which spikes when market panic rises. A yield curve inversion, where short-term Treasury yields exceed long-term ones, has historically preceded recessions. But here's the key takeaway. Most financial experts suggest you focus less on predicting the next market cycle and more on building a diversified portfolio that can weather any environment. This chart shows why dollar-cost averaging, investing a fixed amount regularly regardless of market conditions, is such a powerful strategy during bear markets. Imagine investing $500 every month starting in January 2022, right before that year's bear market. As prices dropped, your $500 bought more shares each month. When the recovery came, all those cheap shares appreciated significantly. This chart compares two hypothetical investors over that cycle, one who invested a lump sum at the peak and one who dollar-cost averaged through the decline. The DCA investor came out ahead, not because they were smarter, but because their strategy removed emotion from the equation. This is for educational purposes only, and all investing carries risk, but the data behind DCA is compelling. Here's the number Marcus prints out and keeps above his desk: 100%. Every single bear market in S&P 500 history has been followed by a full recovery and new highs. Now, past performance does not guarantee future results. That's a critical disclaimer. But that unbroken historical track record is what allowed Marcus to stay invested through the next market downturn instead of panicking. He finally understood. Volatility is the price of admission for long-term returns. Bear markets are not the end of the story. For investors with a long-time horizon and a diversified portfolio, they have historically been a chapter, not the conclusion. Today, Marcus's portfolio has crossed 6 figures. He didn't do it by predicting markets. He didn't time the bottom. He just stopped letting fear make his decisions. Here are the 4 things to take away. 1. The historical math strongly favors staying invested through market cycles. 2. Bear markets are temporary, historically averaging under a year. 3. Dollar-cost averaging lets you turn market dips into long-term advantages. 4. Your emergency fund and diversification are your armor. The best investors aren't the ones who avoid bear markets. They're the ones who stay rational when everyone else panics. Consider speaking with a licensed financial advisor to build a strategy that fits your specific situation. Everything in this video is for educational purposes only and does not constitute financial advice. The examples and data presented are based on historical performance and are not guarantees of future results. All investing involves risk, including the potential loss of principal. Please consult